This afternoon. Let's go to get a separate view with Shawn Hickman from Research Lead at Market Makers, who's standing by here next to me in the studio. Shawn, welcome to the program.
Nice to be here.
Let's go and talk RBA to go kick off with. It's going to be one of the big events here domestically today. What are your expectations, first of all, about what we'll see from the RBA when it comes to the size of the rate hike coming through?
I'm a little bit more on the fence than a lot of people. I think they'll probably go 0.5 because they haven't shown enough autonomy to do what they want to do. I think they only want to go 0.25. We've had the rhetoric recently, it's been a little bit softer. Next year, this time next year or by Christmas next year, 90% of Australian home loans will be linked to the RBA cash rate or be refixing at higher rates. That's going to put a lot of pressure down the pipe, and I think they can feel that coming through already. Housing prices are falling, as we know, share market's falling. I don't think they want to put the foot to the metal just here.
Do you think we might go and get what's a dovish 50 basis point hike? I never thought I'd actually be saying that, but the way that it's constructed, because you make the very logical point there that the follow through, the lag time it takes to go and see that increase in mortgage rates flow through to the actual households is quite a period of time. We've got a lot of fixed rate facilities that won't really start to mature to the first half of next year. Does that maybe give the banks a reason to go and say, maybe just signal a step down in pace or even a pause for the time being to go and see how what they've already done will go and filter through?
I just think, to me, the logical move would be 0.25 and just take it a bit easy and just see what's going to happen. Give yourself a bit of time, stand back and say if we have to go harder next year, we could again. But I don't know if they will. I think they're going to be looking at what's happened in the Bank of England. They'll be looking at what's happened especially by the Fed, and they might just say, okay, we have to do 0.5 because of the pressures externally.
Shawn, when it comes to the expectations of other central banks out there at the moment, last night we saw a big reduction in expectations for where the terminal rate will be for the Fed funds rate and other central banks around the world, and whooshka, all risk assets up and about and don't really flying. A lot of people there, a lot of investors are now sitting back and saying, okay, well, it's the start of a new month, it's the start of a new quarter. Can we believe the price action that we saw overnight? Have you got a view on that?
Well, I've been in here for the last 3 or 4 weeks and I've been bullish every time, and I've said every time we're going to get a good low, in our opinion, September, October. I think we could have seen it. The market, in our opinion, is looking for a low. Don't forget, we've now just entered, or haven't been in it very long, the strongest quarter of the year, historically. Maybe most of that does happen in December, but I think the market goes up from here. I think we'll go back above 7,000 before Christmas. The market's short bonds, it's short equities, and I think we're going to get a squeeze of fear of missing out, very similar to what we saw June, July, August.
We know what real yields, nominal bond yields have been so influential when it comes to dictating how risk assets have performed over the course of the last couple of years. Do you think that given positioning in the moment and the fact that we've got so much hawkish priced in, that we might actually go and see some of that really stripped out and potentially go and lead to more sustained rally? Yeah,
sustained is a big word. I can see us squeezing up to those August highs, as I said before. Do I think we're going to go off to the races? No, I don't, because you've still got a big differential between real rates, as you know. The 10-year bond in the US is close to 4%, it's come back off a bit. S&P only yields under 2%. There's a 2% gap there for security. It's hard to see them pushing equities too high, but you've got a lot of fund managers, they're lemmings, they hate to miss out, they're sitting on cash, they're feeling complacently comfortable sitting on cash,
sure.
But that may not look very good in 3, 4, 5 weeks' time.
Low and no yielding assets did particularly well last night. The precious metal space, we got the double whammy not only of lower yields but also the weaker US dollar. Gold was up nearly 2% or so. Silver was up 9% when I last looked before shutting. Really unprecedented moves and very, very volatile. When you look at the precious metal space, it's been really, really suppressed recently. Is it one of those areas that you could go and start to look at and say maybe there's some opportunities moving there?
Definitely. Again, something we've covered the last couple of weeks. Silver is a volatile beast. It really can get crazy. Last night, 9%. It could be down 5% tonight. It still look quite good. I think the next $100 in gold is up. Will it be straight up? I doubt it, but I think gold goes up. And importantly, people are very underweight gold stocks for good reason. I think the next few dollars and say Northern Star's up.
Okay. In terms of broader asset allocation, when it comes to equity universe here locally, what do you want to be looking at in this kind of environment? It's pretty volatile still out there at the moment, but we have a lot of hikes priced into these markets. What kind of things are you looking at?
Okay, I think you've kind of touched on it before. The low yielding, yield sensitive stocks that have been hurt the most this year, but the quality end of town. Keep with the quality. Don't go too far outside of that. Sure, you might make some spectacular gains by buying stocks that continue to lose money, but buy the yield sensitive quality stocks, including gold, and I think you'll be feeling good at Christmas.